The United States population is expected to grow slowly, making labor force participation more important to the future size of the United States labor force. Since 1948, United States labor force participation rate tracks reasonably well the working life of baby boomers. Baby boomers are usually defined as those born between 1946 and 1964. The labor participation rate did not consistently exceed 60% until 1969 when the oldest baby boomers were 23. Participation peaked at 67% in 1994 to 2002, then began to decline. The decline accelerated in 2008, which coincided not only with the United States real estate crisis but also with the oldest baby boomers turning 62, the earliest age to collect Social Security. When even the Fed chair questions the need to lift interest rates further, despite the lowest jobless rate in nearly half a century, you know something odd is happening with inflation. That something is largely due to the restraining effect of automation and digital technologies. Advanced automation is raising business efficiencies, suppressing wage demands of workers anxious about displacement, and lowering the cost of information and communications gear. In fact, automation has the potential to reduce inflation on a wide number of fronts. Labor income has declined as a share of total income earned in the United States. In other words, labor income, which includes wages, salaries, and other work-related compensation, has declined relative to capital income, which includes rent, interest, dividends, and capital gains. Though both labor income and capital income have increased over time, capital income has increased at a faster rate. Reasons why labor's share of total income has declined is that technological change has favored investment in capital to labor. Technological shifts have put strong headwinds on wage growth. Another reason is globalization, which allows firms to import goods from other countries rather than producing them and paying labor to produce them in the United States, and there's also the loss of bargaining power by labor. Market incomes, before taxes and benefits, for the average working-age American adult actually fell between 1980 and 2014, reversing the strong upward trend of previous decades. The incidence of low-wage and very low-wage jobs, which is termed poverty wage, grew, spectacularly so for young workers, age 18 through 34, with less than a college degree. The poverty wage share even increased for workers with a college degree. Young workers also experienced sizable declines in their median wage, males after 1979, women after around 2000. These are the most important explanations and evidence for the declining job quality in the United States, which has led to today's low labor force participation rate and the lack of persistent inflation.